everyone, welcome back to Mindful Investing. Today we are talking about Netflix, a stock that's been on tear but now faces one of the most crucial earnings report yet. Earnings are coming up this Tuesday after market hours and expectations couldn't be higher. And over the past week, I've enhanced my stock prediction model. I've added bull, base and bear case scenarios, added a couple of discounted cash flow calculations and made the model more realistic to account for valuation compression as growth stabilizes. So today we'll use that updated framework to see how Netflix look heading into earnings, what fair value could be under different growth paths, and whether this stock is still a buy, hold or take profits candidate after such a huge run. Netflix is actually up 36% year to date, making it one of the best performing names in the streaming space. Yet the question now is, can it keep this momentum or is the growth story peaking? Because under the surface, things are getting very interesting. The advertising tier is scaling fast, subscriber growth is rebounding post password crackdown, but content spending and competition from Amazon and YouTube are heating up again. And this time, I've modeled all of it: the growth assumptions, the valuation glide path, and what kind of EPS and price trajectory Netflix might see under each market scenario. Before diving into the valuations, I took a close look at Netflix balance sheet, and honestly, it's phenomenal. With about $1.9 billion in cash and $8.5 billion in free cash flow, their financial health is very solid. There's really nothing concerning here. So I won't spend much time on it. And let's break this down step by step, starting with the bull case scenario. What could go right for Netflix if the upcoming earnings blow past expectations? The bull case, which is built around Netflix proving that its growth story isn't over, it's just entering a new phase. Under this scenario, I'm assuming EPS growth of about 22.8% per year, supported by continued subscriber additions globally, strong momentum in the ad supported tier, and ongoing margin expansion as content spending stabilizes. If Netflix continues executing like this, my model projects EPS climbing from 23.47 today to over 65 by 2029. That's nearly a 3x jump in earnings per share. And if the market continues rewarding Netflix with a high growth multiple, say around 51 times earnings, similar to today's, that would imply a 5-year stock price of $3,400, which is roughly a 180% upside from current levels. Even in the short term, say over the next 12 months, this model points to a price target around 1490 or about 24% higher than where we are now. Here are a few reasons why I think this can play out, and these are important if you are watching earnings this week. The number one is the ad tier is working. Netflix has cracked the code on monetizing its massive user base without losing premium subscribers. Number two is their paid sharing. Paid sharing has turned out to be a revenue booster, not a drag. It's bringing lapsed users back into the ecosystem. Number three is their free cash flow. It has crossed $8 billion, and that's after heavy content investments. That means Netflix is now self-funding its growth. Number four is their management discipline. They have pulled back from wild spending and are targeting operating margins of 24 to 26% long term. So if these trends continue and earnings surprise to the upside, the stock could easily retest all-time highs, possibly even break $1,500 in 2025. But that's the optimistic view when everything is growing right, growth staying strong and valuation holding up. Now let's step into the base case. What happens if growth normalizes and the market starts valuing Netflix like a mature cash generating tech company instead of a high growth streamer? In this case, I'll assume Netflix continues to grow, but not at the same pace of the past few years. In this scenario, I'm assuming annual EPS growth rate of around 18%, which reflects a more mature subscriber base, slower expansion in North America, and modest contribution from the ad tier and paid sharing. So if earnings rise from 23.47 today to about 54 in 5 years, the PE multiple compresses slightly from 51 to around 43 as the market re-rates the stock toward a more steady compounder. We get a 5-year price target around 2,390, about 97% upside from today's level. But here's where it gets interesting. When we are applying different valuation lenses using the Peter Lynch fair value model, which essentially values a company based on its growth rate plus PE relationship, Netflix fair value today comes out to around $535 per share. That's a big gap from its current price near $1,200, suggesting the stock is overvalued in the short term. Even my earnings based discounted cash flow, which discounts future earnings back to present value, lands at roughly $730, reinforcing that idea. So while long term fundamentals remain strong from a valuation perspective, Netflix looks stretched heading into earnings. To me, this is a prove me phase for Netflix. Investors want proof that growth in advertising, gaming, and new content regions can sustain those high multiples. If earnings on Tuesday show continued margin strength and improving global subscriber trends, the stock may hold its premium. But if there's even a hint of slower growth or guidance cuts, we could see a sharp pullback toward the $1,000 to $1,100 range. So that's the balanced view. Solid fundamentals, but maybe too much optimism baked in the price. Now, let's flip to the bear case, where growth slows more sharply and sentiment shifts towards caution. In this case, I'm assuming Netflix growth momentum fades and the market takes a more cautious stance. Here, I'm assuming EPS growth slows to around 13.7% per year. That's still healthy, but a noticeable slowdown compared to the last few years. Under that assumption, earnings would rise from 23.47 today to roughly 44.5 in 5 years from now. And since lower growth usually means lower valuation multiples, I'm using a PE compression to around 36, down from the current 51. That gives us a 5-year price target of near $1,600, which is about 33% upside from today's level, and a 1-year price target around $970, roughly 20% downside. So, what would cause this kind of slowdown? Number one is content fatigue. After years of non-stop investment, Netflix might struggle to deliver enough new hits to justify higher subscription prices. Number two is competition intensifies. Disney Plus, Amazon Prime, YouTube, and even TikTok are pulling away attention, not just subscribers, but screen time. Number three is margins under pressure. As Netflix expands into gaming and ad-supported tiers, operating margins could flatten before rising again. Number four are macro headwinds. A stronger dollar or recessionary pressure could hit international growth, which now drives most of Netflix new additions. So in this bear case, Netflix is still a good company, just one where expectations catch up to reality. The stock has already priced in perfection, and if even one growth lever stumbles, we could see a valuation retest closer to fair value. That's not a collapse, it's more like a reality check for a stock that's run too far ahead of its fundamentals. But remember, models are just scenarios. To really see where Netflix is heading next, we need to connect these numbers with what's actually happening in its business today. So now, let's walk through the key earnings signals I'll be watching this Tuesday and how I'll decide whether to buy, hold, or wait for a better entry. Because remember, numbers are just probabilities. What turns a model into conviction are the signals that company gives you quarter after quarter. Number one is their subscriber growth and average revenue per user. This is the heartbeat of Netflix business. If subscribers additions come in stronger than expected, especially in Europe and Asia, that supports the bull case I outlined earlier. But if growth slows, particularly in North America, that might indicate we are entering the base or even bear case territory. Average revenue per user is equally critical. With Netflix pushing price hikes and ad tier expansion, I'll be looking for a meaningful uptick here. Even a few percentage points can change valuation trajectories dramatically. Number two are their free cash flow and margin expansion. One of the biggest drivers of Netflix re-rating has been its free cash flow story. The company is finally generating strong positive free cash flow, but the key question now is that sustainable? If they can maintain or grow free cash flow margins despite rising content costs, it signals true operating leverage that supports a long-term PE premium. But if free cash flow slips, it tells me they are still dependent on hit-driven cycles, a red flag for consistency. Number three is content spend efficiency. This is where fundamentals meet storytelling. I'll be tracking content amortization versus new cash content spent. Basically, how efficiently is Netflix turning every $1 spent on new content into new engagement and ad revenue. If that ratio improves, it strengthens the argument for durable growth. If not, it might be a warning that content spend isn't translating into value anymore. Number 4 is regional mix and currency headwinds. Almost 60% of Netflix revenue now comes from international markets, so FX volatility is a real factor. I'll be watching management commentary closely for any mention of currency translation effects or localized pricing strategies. If they are seeing softness due to the strong dollar, that could impact near term guidance. Number 5 is their forward guidance. This is where the markets really react. Even if Netflix beats on EPS, weak guidance for Q4 or early 2026 could send the stock lower in the short term. What I'm really hoping to see is balanced guidance, not overly optimistic, but showing confidence in margin stability and steady free cash flow growth. That would fit perfectly with my base case scenario, the one I personally lean toward heading into this report. So, here's my approach. I'm not trading Netflix around earnings. I'm watching the numbers, the commentary, and how the market reacts. If we get a correction post earnings and the fundamentals stay intact, I'll see it as a potential long term buy the dip opportunity. I'd consider adding in around the $950 to $1,050 range. That's where valuation and long term potential aligns best in my model. Because remember, great businesses don't need perfect quarters to keep compounding. Netflix is a fascinating company, a perfect example of a business transitioning from high growth to mature profitability. So, while the days of 10x returns might be behind us, the next phase could be all about steady compounding and consistent free cash flow generation. Now, I want to hear from you. What's your fair value estimate for Netflix? Do you think it deserves this kind of premium valuation? Or is the stock getting ahead of itself? Drop your thoughts below. It will help not only just me, but many others watching this deep dive. And if you found this analysis helpful, don't forget to hit like, subscribe, and share it with your investing community. Because the goal here isn't just predicting stock prices, it's understanding why they move the way they do. Thanks for watching. See you the next time with another in-depth model review and hopefully a market that gives us more opportunities to buy quality businesses at fair prices.